Good afternoon, and welcome to the African American Chamber of Commerce of Western Pennsylvania's Business Institute program this afternoon. Our mission is to continuously improve business opportunities and tap the expertise of the financial academic communities to strengthen our members for competing in the global marketplace. We are thrilled to have with us this afternoon Loretta J. Mester, who is the president of the Federal Reserve Bank of Cleveland. Before I formally introduce her, let me just share with you that if you have a question, and there are approximately 220 of us on this webinar, so we're pleased to have you as well as the media present with us. You can go in the chat room if you have a question, and we will try and address as many as we can at the conclusion of her presentation. Loretta Mester took office in June of 2014 as the 11th President and Chief Executive Officer of the Federal Reserve Bank of Cleveland. She participates in the formulation of U.S. monetary policy and oversees 1,000 employees in Cleveland, Cincinnati, and Pittsburgh who conduct economic research, supervise banking institutions, and provide payment services to commercial banks and the U.S. government. Before becoming president of the Cleveland Fed, Dr. Mester was executive vice president and director of research at the Federal Reserve Bank of Philadelphia, where she began her career as an economist. Dr. Mester is active in the community. She is a director of the Greater Cleveland Partnership, a trustee of the Cleveland Clinic, a trustee of the Cleveland Orchestra, and a director of the Council for Economic Education. She was born in Baltimore and earned a PhD degree in economics from Princeton University. And I might say that she is no stranger to the Pittsburgh audience that is online with us, having been our speakers 2 years ago for our annual business luncheon. It's my pleasure to introduce and turn the mic over to Loretta J. Mester. Loretta?
Thank you very much, Doris. I really appreciate the kind introduction. And I want to thank the members of the African American Chamber of Commerce in Western PA for the opportunity to speak with you today. You probably know that Doris is a member of the board of directors of the Federal Reserve Bank of Cleveland. And in the best of times, the valuable insights provided by Doris and her fellow directors and all of our contacts help us assess economic conditions and formulate monetary policy. But of course, these are not the best of times. And I really can't emphasize enough the importance of the information that Doris and our other contacts are providing. It's real-time, on-the-ground reconnaissance of how businesses and households are faring during the evolving pandemic. So while the outlook remains uncertain, one thing I am certain of is that we all have a better understanding at the Fed of the economic impacts of the pandemic because of the public service of our directors and contacts. So really heartfelt thank you, Doris. Now, it's clear that the adverse effects of the pandemic have not been evenly distributed. They've been borne by the most vulnerable in our economy, lower income and minority workers and communities, those who don't have the opportunity to work from home, and those who don't live in areas with reliable telecommunications, internet services, or access to adequate health care. And as I'm sure your audience knows, the smaller the small businesses. Indeed, the results from a recent Fed in March and July, a larger percentage of low-income workers, less educated workers, and Black and Hispanic workers were laid off compared to higher income, more educated, and white workers. Rehiring by employers has been slower for lower income workers than for higher income workers. And in addition, from February to April, the number of active small business owners dropped by 3.3 million. That's a record 22% decline. Compared to small firms overall, Black-owned businesses have been twice as likely to close, and Hispanic-owned businesses have been 1.5 times as likely to close. And it's distressing to see this disparate impact of the pandemic. But the differences in economic outcomes did not start with COVID-19. There were already long-standing economic disparities in our economy. So today, I'm going to step back from the effects of the pandemic per se and examine the differences in economic opportunity that so many in America still experience at every phase of their lives. And I'm going to conclude with some thoughts based on the research that I'll be speaking about on where we might focus in order to reduce these gaps and promote economic inclusion. And of course, as always, the views I'll present are my own and not necessarily those of the Federal Reserve System or my colleagues on the Open Market Operating Committee. So the Federal Reserve's mission is to promote a healthy economy and stable financial system in the U.S. Our monetary policy decisions, our actions as supervisors and regulators of banks, our role in the payment system, and our efforts to promote community development in low and moderate income areas all contribute to achieving a well-functioning economy and financial system in which everyone can participate. Opportunity and inclusion are important for achieving a strong economy, and the recently announced revisions to the Fed's strategy for setting monetary policy explicitly states that we view maximum employment, one part of our statutory mandate, as a broad-based and inclusive goal. Unfortunately, today, the U.S. economy does not offer the same opportunities to all. There are racial disparities in educational attainment, labor market outcomes, and access to credit. People born into areas of concentrated poverty or predominantly minority areas are disadvantaged over their entire lifetimes, and so are their children. Unless actions are taken to promote an inclusive economy, one in which people have the chance to move themselves and their families out of poverty, one in which systemic racism does not limit opportunities, and one in which all people can fully participate, the U.S. economy will not be able to live up to its full potential and the country will suffer. Now I'm going to share some slides and work through a set of slides that I think will show you what I mean. So all parents want to know that their children will be better off financially than they are. An important part of the American dream is the idea that anyone can climb up the ladder through hard work and perseverance. But upward mobility, the probability that a child will be better off economically than his or her parents, has fallen sharply in the U.S. since World War II. At last year's Cleveland Fed Policy Summit, Harvard professor Raj Chetty presented some of his seminal research on income mobility. Around 90% of children born in 1940 earned more at age 30 than their parents did. But by the mid-1980s, only about 50% did. And although it's not shown on this figure, the largest declines have been in the middle class. Now, many factors have contributed to this decline. One contributor is rising income inequality, which leads to advantages in terms of education and other social factors for those in the higher income groups compared to those in the bottom. Since the 1960s, the median level of income adjusted for inflation has risen over time, from about $48,000 in 1967 to about $69,000 in 2019. But those in the top 10% of the income distribution have enjoyed sharper gains than those in the bottom 10%. The U.S. has one of the lowest rates of intergenerational mobility among advanced economies and more pronounced income inequality. Now, to get the full picture, we need to look at disaggregated data. Research by Chetty and his co-authors shows that upward mobility depends not only on the family's characteristics, but also on neighborhood characteristics such as neighborhood income, racial integration, the quality of schools, and access to social services. Now on this map, areas of relatively high intergenerational mobility are shown in shades of blue-green. So children who grew up in these places earn higher average income by the time they're in their mid-30s than their parents did at the same age. Now shades of red here in this map indicate areas of low intergenerational mobility, places where children have not progressed very far in terms of income relative to their parents. Now, as you look at the map, an important insight is that even areas with fairly good economies in terms of stronger growth, output growth and job growth, so like think about the South, like Charlotte, North Carolina, they have not necessarily produced higher levels of upward mobility for the children growing up there. So strong economic factors certainly help, but they're not a panacea. I thought you'd like to see what the map of Pittsburgh looks like. What you can see here is mobility differs quite a bit across the city. If you were to drill down even further, you could see differences even within neighborhoods. In fact, the research shows that moving a child from a low mobility neighborhood to a high mobility neighborhood can have profound effects on his or her future economic outcomes. And I find it interesting that this is true not only in the US, but also in countries like Australia, where income inequality is lower than it is here. So place matters, but so does race. Research by Chetty and co-authors has found that there is a gap in earnings between Black males and white males, even if their parents were at the same income level and they grew up in the same neighborhood. The research also shows that even conditional on where a child grows up, Blacks have a significantly lower chance of moving up in the income distribution than whites or Hispanics, and a higher chance of moving down in the income distribution. Now, this is a complicated chart, but what you can see is in the left-hand panel, it's about upward mobility. Low-income parents, what's the percentage of their children that will move up to the highest income quartile? The second graph, downward mobility, shows, okay, you're born to high-income parents. What's the chance that you'll move down to the lowest income group? And the right-hand panel is, you're born of high-income parents. What's the chance you'll stay high income? The striking thing here is that Blacks who happen to have been born to parents in the highest income quintile are almost as likely to move down to the lowest quintile as they are to stay in the highest one. Now, according to the most recent Federal Reserve Triennial Survey of Consumer Finances, in 2016, median income for white households was about 1 3/4 times that of Black households and about 1.5 times that of Hispanic families. And I should say that in this talk, I'm using race to mean race and ethnicity, and I'm using Hispanic to also be Hispanic Latinx. Earnings are an important driver of family net worth, which is financial and non-financial assets like homes and autos, net of debt. Racial gaps in net worth are much larger than income gaps. The median net worth of white families in 2016 was almost 10 times as high as that of Black families, and about 8 times as high as that of Hispanic families. And these gaps are not a recent phenomenon. They've been around for decades. Many factors play a role in these gaps in income and net worth. In fact, if we look over a person's life, racial gaps exist every step of the way. From the beginning of life, Black children have only half the chance of reaching their first birthday compared to either white or Hispanic children. These gaps in infant mortality have existed over many years, and even if you control for the educational level of the mother, the gaps remain. Now, Black and white children tend to grow up in different neighborhoods, and this racial stratification leads to other risks that can affect longer-term economic outcomes. One example is children's lead toxicity, the amount of lead in one's bloodstream, which at elevated levels causes brain damage and has significant adverse effects on a child's ability to learn. A study of Chicago neighborhoods found that even though lead poisoning in children has fallen significantly over time as a result of public health policy, it is still the case that those neighborhoods with the highest levels of toxicity are predominantly Black neighborhoods. Now, while lead poses one significant disadvantage to learning, lack of internet connectivity poses another. Well before the coronavirus pandemic, access to the internet was an important avenue for education as well as for healthcare and job access. Usage of broadband at home is comparatively higher for whites, those with higher incomes, and those in urban and suburban areas. Blacks and Hispanics are less likely to have a computer or broadband at home than whites. And when they do have a computer, they're less likely to have broadband services at home. So this puts Black and Hispanic families at a disadvantage, especially now, given that the pandemic has made remote in-home learning the norm rather than the exception. In fact, during the spring, students in lower income neighborhoods completed significantly fewer math courses online than those in higher income areas. And if these differences continue, there could be lasting effects on students' earning potential throughout their lives, leading to further inequality. Indeed, the accumulation of human capital via education is an important path to economic inclusion and opportunity, resulting in better economic outcomes for individuals, households, and the country at large. The median income for families whose head has a college degree is more than twice as high as that of a family whose head has only a high school diploma. Similarly, median net worth is considerably higher for those with a college degree. Now, while our workforce as a whole has become more educated over time, educational attainment differs by race, as does the likelihood of completing a degree. In the Fed survey of consumer finances, 39% of white heads of household held a college degree, compared to 23% of Black heads of household and 17% of Hispanic heads of household. Now, cost can be an important barrier to entering college, particularly for those from lower income families. The average cost of tuition and fees at four-year institutions is now over $16,000 a year, and adjusted for inflation is more than doubled over the past 3 decades. According to the Fed survey on economic well-being, as of late 2019, over 40% of those who went to college had taken on debt for their education, and about half of those people still owe money on that debt. New York Fed analysis shows that compared to borrowers in majority white areas, those in majority Black areas have higher student loan balances, and those in majority Black and majority Hispanic areas have higher rates of default on those loans. These defaults can follow a person over time, making it harder to access credit in the future. Now, for those students who do find the financial means to enter college, the likelihood of completing a degree differs by type of institution and by race. The completion rates have remained particularly low at for-profit institutions. At both public and nonprofit private institutions, the graduation rates for whites, Hispanics, and Asians have all risen over time, but those of Blacks remain well below those of these other groups and have shown no progress over time. Satisfaction with college also varies by race. About 70% of white recipients of bachelor's degrees felt that their education was worth the cost, but only slightly more than half of Black recipients did. Now, differences in educational attainment across races follow people as they enter the workforce. There are significant racial disparities in labor market outcomes. Unemployment rates among Black and Hispanics have been chronically above those of whites and Asians, and Blacks and Hispanics are more likely to lose their jobs during recessions. Now, although some progress had been made over the long economic expansion that ended in February, racial disparities remain. Research from Fed economists indicates that while lower educational attainment explains much of the difference in the unemployment experience of Hispanics, this is not true for the Black-white gap. In fact, observable characteristics like education, age, or marital status cannot fully account for the higher and more cyclical unemployment of Blacks relative to whites. These long-standing labor market disparities spill over in other ways that limit Black households' ability to fully participate in the economy. Worse and more volatile labor market outcomes make it harder for non-white families to build assets and achieve sound financial health. For those families that are able to get a mortgage, job insecurity makes the household less financially resilient and raises the risk that the household might fall behind on its mortgage or even default, putting the family's longer-term financial health at risk. Housing continues to be an important way for families to build wealth, but even controlling for income and other factors related to creditworthiness, there is a rising gap between the home ownership rate of whites and blacks. This indicates that systemic racial differences in access to credit have persisted well after enactment of fair housing and lending legislation in the 70s meant to address the scourge of redlining and discrimination in credit markets. Now, in terms of access to financial services, blacks and Hispanics are less likely to have a bank account and more likely to rely on alternative financial services such as money orders and check cashing services than whites. Being unbanked or underbanked makes it harder for these families to build a credit history. The use of bank financing by small businesses also varies significantly with the race of the owner. According to the Fed's Small Business Credit Survey, compared to small firms with white ownership, those with black ownership were half as likely to obtain financing from a bank in the past 5 years, relying more on online lenders, which, according to survey respondents, provide less satisfactory service. Now, eliminating racial and economic disparities, which have lasted over generations, is no easy task. It's going to take concerted action at the individual, professional, and institutional level to change structures and systems that perpetuate these gaps. But this work needs to be done so that all people have the opportunity to fully participate in the U.S. economy. The research I discussed today points to 4 priorities. Investing in neighborhoods and communities must be a priority. Place matters, and at smaller geographical divisions than might be expected. Localized, neighborhood-based community development work and investments aimed at reducing poverty rates, improving school quality and housing choices, and revitalizing neighborhoods can offer families more stability. Focusing on improving neighborhoods can have results. In 2016, the Cleveland Fed convened all those interested in contributing to the efforts of the Lead Safe Cleveland Coalition in the city of Cleveland in preventing lead poisoning in the city. And last July, Cleveland City Council passed an important piece of legislation requiring, among other provisions, that landlords pay for private inspections and certifications that their occupied units are lead safe, with penalties for noncompliance. Closing the digital divide must be a priority. Among communities with a population of 100,000 or more, the city of Cleveland has among the lowest home broadband access in the nation. Business leaders through the Greater Cleveland Partnership are working with the city's governmental leaders and other organizations to ensure that all residents in the Greater Cleveland area have access to in-home, high-quality broadband and the devices to access it. And I should say that similar work is being done in Pittsburgh by the Allegheny Conference on Community Development, although you have much more broadband at home, basically at the same as a national level than Cleveland does. Increasing access to high-quality education at all levels must be a priority. Education is a significant avenue to economic opportunity. Recognizing that a higher skilled workforce benefits communities, Ohio has a project underway to try to increase educational attainment. Issues with cost and preparation need to be addressed. Respondents to recent Fed surveys say that the cost of college and family obligations are among the reasons they did not complete their degree. Low grades were also cited as a reason. So adequate preparation for college has an impact on completion rates and likely on satisfaction. Research is increasingly pointing to the fact that children who fall behind have difficulty catching up. Tutoring and mentoring throughout a student's elementary, high school, and college years can support a student through to earning a degree. And in addition, financial literacy should be included in elementary and high school curricula. Such courses will give students the skills to evaluate the various options for financing their education, determine which types of educational institutions offer a good return on their investment, and lead to better savings, investment, and credit decisions throughout their lives. Now, the Cleveland Fed actively supports economic and financial literacy programs, and this year we'll be hosting the Council of Economic Education's National Personal Finance Challenge, a competition for high school students that encourages development of financial management skills. Eliminating systemic inequities in access to credit and financial services must be a priority. The financial disparities that still exist in banking and credit markets mean institutions need to reassess their business practices and change those that are found to be sources of such disparities. Similarly, policymakers need to strengthen policies meant to address such inequities. The Federal Reserve is currently working to strengthen the regulations that implement the Community Reinvestment Act. The act, passed in 1977, was intended to help address concerns about disinvestment in low and moderate income neighborhoods and the impact of illegal practices such as redlining. The CRA reaffirmed that insured depository institutions must serve the communities in which they're chartered to do business. And evidence shows that the CRA has provided tangible benefits to low and moderate income neighborhoods. Now, with the many changes in banking since the 1970s, it is time to modernize the regulation so that it can help to address systemic inequities in access to financial services and credit for low and moderate income and minority communities and individuals. Of course, much more needs to be done. But if we have focus, perseverance, and a shared commitment to eliminating systemic racism and increasing the breadth of economic opportunity, then together we can ensure that instead of being a pipe dream for some, the American dream is available to all. I'm going to end my prepared remarks now, and I'm looking forward to answering some questions. Thanks for listening.
And thank you, Loretta, for your comments. Some startling information, but solid recommendations on how to improve the situation. I'd like to, before we open it up for questions, thank PNC Bank for serving as our sponsor for this webinar. Anyone that has questions can feel free to go in the chat room and enter them. But let me begin with a couple questions, one question in particular that I think everyone has on their mind, and that is, what do you think the outlook is for the U.S. economy, and how long do you think it will take for us to recover from this pandemic?
So thank you for that question, Doris. So I like to think about this in terms of phases. So of course, the economy was shut down in March as it became clear that we needed to do that for public health reasons. So that, you just saw this sharp decline in both hiring, employment, and output growth and economic activity. Then as things got a little better on the healthcare front, the economy began to reopen in May. And when that happened, you saw activity picking up, granted from very low levels. And of course, it's not picked up everywhere. It's picked up in areas that are where people can work at home. It's picked up in areas that are very responsive to low interest rates. For example, you've seen a pickup in the housing market. We've seen a pickup in the auto sector. We haven't seen a pickup in areas like restaurants, small business activities, where you really need to be face-to-face, those service sector positions. So it's almost like a tale of two cities. You have a lot of the economy now, activity is picking up, but we have a great part of the economy, travel, leisure, and hospitality, where you're not seeing the pickup. I think that's going to continue for some time. I mean, we still have the economy very much driven by what happens with the virus. And as you see the virus picking up in places, you see people pulling back from economic activity. So in some sense, we're going to see this, some of the data is going to look good in the third quarter because we're coming off of a deep hole in the second quarter, and any increase in activity is going to look like a big increase. But that's really misleading. We're still in a deep hole. We lost in just 2 months, in March and April, we lost 22 million jobs. That's the same level of jobs we had made over that 10-year expansion. Now, since then, we've regained 11 million. So we've regained half of the ones we lost in those 2 months, but we're still in a deep hole. We're still down 11 million jobs. And that phase of the recovery, which I call sort of the after the reopening phase, where we're in the regular kind of recovery, I think that's going to take quite a while. I think it's going to take a while for commercial real estate markets to come back. There's going to be a lot of, rethinking about office space. I think a lot of people are not going to go back to the same job they had before. A lot of small businesses are not, we've already seen them shut down. I think a lot more may close if we don't have support from the fiscal authorities, and that's getting less likely as we go forward. So I think we really need some more fiscal support, and the monetary policy support. As we've said we expect to be very accommodative for quite a long time, and I think with those in place, then we can expect the recovery to sort of gain some traction. Right now, I think it's fragile. I think it's disparate across different sectors. We need to have more time and more support so that it can broaden out and be more sustainable. And I think that's the next phase. So I think that's going to take some time from now. And of course, it's all conditional on what happens with the virus and what happens with healthcare.
Wonderful. As director of the Cleveland Fed, I'm familiar with the work that the Federal Reserve is doing to promote diversity and inclusion. What sort of progress has made the Fed over the years successful, and why are you focused on this?
Well, Doris, and we've talked about this many times, we firmly believe, and I firmly believe, that the Fed should represent the constituencies we serve, and all the constituencies. Like we want to gain insights from everyone. Our monetary policy, for example, affects all people. So it's really incumbent upon us to really know what's going on in neighborhoods and communities across the whole country, and certainly in the 4th District. So I think that's very important. We need to represent the people we serve. The other reason is something I mentioned in the speech, which is, of course, if everyone can participate fully in the economy, we have a better economy, right? I mean, and we're charged with trying to make sure that we set policies to make the economy run well and financial markets run well. And you're not fulfilling that mission if a large part of the economy of people aren't able to fully participate. So for both our mission, right, and the fact that we are public servants and we're supposed to represent our constituents, I think it's really important for the Fed to do it. We have been making progress. We've been trying to focus in on this for quite a long time, as you know, Doris. You're never done, right? It's a journey. It's not a destination, right? We're not going to be done. We're always going to move forward. When I started at the Cleveland Fed, it was clear that we wanted to do more to diversify the people on our board. Again, we get insights. You get better policymaking when you hear from very different walks of life, different views on different sectors, and also racial diversity and gender diversity was an important goal. So we've really increased it. We've almost doubled the amount of women on our 3 boards, Pittsburgh, Cincy, and Cleveland, and we've made progress on almost doubling the number of, I think more than doubling the amount of minorities on our boards, and I'm proud of that. But it takes a lot of effort, and some of the things you have to do is you have to be willing to look farther, look longer. You have to be willing to say, you know what, we're looking for people, not titles. I think that's really important, and any organization can do that, and I think that brings success. And that's something we're going to continue to do. We're going to do it. We're doing it through all of our business advisory groups. We focus in on that. And then you have to focus in also in your own organization, right? It's important for the Cleveland Fed itself to practice what it preaches. So, we've made diversity, inclusion, and opportunity an important goal for our bank. We have it elevated in an organization. It's at the highest levels on our executive leadership team. We actually put in an incentive goal for the team. It's a team goal that ensures that when we're hiring, we bring in a very diverse slate of candidates, and we also look at inclusion in the sense of are we retaining the diverse people that we hire, which I think is also very important. We were looking at our organization and we said, well, we're actually doing pretty good on the hiring front. It's the retention part where we needed to focus. And so looking at where your organization is, aspiring to be better, and then figure out how to get from A to B, I think really pays off in dividends. And we're seeing that. But you really have to make sure that everyone in the organization knows it's a priority. And then they can understand it. So it's a change in mindset for some, but once you set the tone at the top, it goes down through your organization, and I think that's been why we've been able to make some progress towards. But again, it's not. I wouldn't say we're there. We got to keep working.
Thank you, Loretta. Yes, you set the tone at the top, but you also work to ensure that not only it permeates every level of the organization, but it's enacted and that they follow through. Let me thank you for being our speaker this afternoon and for PNC Bank for serving as our sponsor. I think you have given all of our participants something to think about. It is a work in progress, and we're all in this together. So let us all move forward to ensure that we reach the parity that we work to achieve. Thank everyone for being on this webinar with us today, and this concludes our session. Thank you.
Thank you, Doris.